I like to read about people that do a lot of good things in their life and do well so I can figure out how to do well myself. I want that to inspire me. These very,
Mhm.
very smart people that made lots of money and keep their money and grow their money, they just don't go to a bank to put the money into their bank accounts. They don't just put the money in bonds, GICs, and stocks and real estate. They do a bunch of stuff. But these smart people seem to find a way to take insurance and use insurance for investing to protect themselves and make money. So, Zachary Rain of Rain Finance, how do we go about using insurance for investment purposes?
That is a great question. You're certainly right that there's a stigma there. And yes, everybody has a lot of different kinds of insurances. And the better you've done for yourself, the more insurance you have, just like Keys, you said. But I guess for the general public, a lot of them don't know about the investment value, the growth value, the asset value of permanent life insurance. So, there's the generic term life insurance, which is what most people think of when they think of life insurance, which is, God forbid I passed away. I have this benefit that pays, for instance, for my mortgage to be paid off or for my kids to be able to go to school or for things like that. And that insurance is great. I'm a big believer in it. Anybody who has financial dependence should have it. But for the wealthier community, the community that has, been able to build assets, been able to build wealth, retained earnings, whatever you want to call it, investing in insurance is an absolutely amazing strategy. There are so many advantages, but if we look at the composition of permanent life insurance, then it's more easy to understand, especially when we compare it to assets that we know from our everyday use. So the best example that I like to give is a well-structured, permanent, and yes, structured, because life insurance, just like many different types of insurances, is built with many different facets. So I say well-structured. A well-structured life insurance policy is very similar to investing in, for instance, real estate. It's treated from a tax perspective in a more advantaged way. So a lot of people won't know unless you're an accountant, in which case you've seen this a lot. The Income Tax Act in Canada has its own section for life insurance because of how it's treated favorably. And what it says is that life insurance death benefits are paid out tax-free, which is an absolutely amazing, amazing benefit of life insurance. And that's just the first one. On top of that, we have permanent life insurance, which has similar qualities towards real estate in the sense that your, let's just say, annual payment behaves just like your mortgage payment. You have a portion that goes towards interests with real estate that you're never going to get back, right? That's the cost of playing with real estate, right? Let's just say that. And then there's another portion that goes towards your principal investment, which goes towards paying down your house. That's the equity that you retain in your home. With life insurance, your payment is exactly the same. You have a portion you're not going to get back. That's the cost of insurance. That's the actuarial side of things, which is, well, if this person dies at this age, what's the likelihood of that happening? What benefit are we paying out? Things like that. But the much larger portion, especially when you're younger, and when I say larger, I mean well-structured, we're talking 70, 80% plus of your contribution to life insurance goes specifically to equity,
So
which is,
let me pause you right there. I have a question for you. So just so we all conceptually visualize this, because we're going to dig really deep into this.
mhm.
So just so we put in kind of numbers so people understand, because the majority of us, Zach, are not going to be on this permanent insurance. Most people, if they have life insurance, generally are on this term insurance, right?
Mhm.
So term insurance, let's say, most popular for people 50 years, 40 years, 30 years. What do you find generally is like a good number?
I'm finding a lot of 30 years.
30?
Yeah, it's the amount of time that it takes to raise kids, the amount of time it takes to pay off a mortgage, the amount of time it takes to build enough assets that in retirement your spouse is self-sustainable, things like that.
So let's take you're the average person. You signed up. You get to if you had to get you're probably getting a physical at this point wherever you're at. You get
Of course.
approved. You got a 30-year term insurance. You're paying $500 a month, $200 a month, $1,000 a month, whatever it works out to. So if God forbid something happens to you in those 30 years, there's a scale of what is being paid out from the insurance company to your beneficiaries, and a discussion done.
Mhm.
If somebody gets that 30-year term insurance, they're paying it every month. religiously. They got their rate locked in. They think they're amazing. They're good. They did it when they're 30. Now they're 60 years old. The
Mhm.
term has come up. Now they come to their insurance broker and they're saying, okay, 30 years is up. I'd like some money, please. What happens there,
Yeah.
Zach?
I wish that was the case. So with insurance, it's always the lottery you don't want to win, right? So car insurance, you don't want to get in an accident. Home insurance, you don't want anything to happen to your house or to burn down, anything like that. No different with life insurance from the temporary side of things, the term, right? You don't want that term insurance to kick in because it means you most likely died prematurely, which we don't want. So, the best case scenario is at the end of those 30 years, I look at you and say, congratulations, the insurance has served its purpose. We've hit all of our other goals, part of the financial plan, and you're not getting a dollar back from the term insurance.
Whoa, so whoa, Zach, you just blew my mind. So I've been paying every month religiously for
Yeah.
30 years. Okay. So I've made 400 payments, whatever the math is, and I've come to it and I'm not seeing a dollar of it. It's
No,
gone.
no, it's gone.
It's gone.
It's
So,
gone.
so now at this point, I'm now 60. So I was 30. I set it up for 30 years. It's now I'm 60 years old. Can I just say, hey, you know what? Can I let's just renew it? Let's keep it going at the same rate and everything. Is that how it works, Zach?
That's a beautiful question. You're right on the nose. So the goal with a lot of financial planners, people who practice financial planning, is to do an annual or even, more often review of insurance. When I come across somebody who's had insurance, for instance, let's say 25 years, their kids have now, moved up and out. So that need really gone. Their mortgage is paid off, if not already in the very, very low areas. So that area, that need is up and gone. So what do we need now? We now need permanent insurance, permanent life insurance for permanent needs. What's going to happen to all of us? It's a guarantee in life. Unfortunately, we all die at some point. Now, when we do we want to leave our families in a better state than we were before? Or do we want to leave them in a state of shambles? Do we want people who we love most dearly to have to worry about to have to worry about money in a time when they're mourning us? No. So what we do is we convert a portion, if not all of the term life insurance they've had into permanent life insurance so that we're at least retaining some value moving forward. That permanent life insurance, it's a guaranteed payout. It's permanent in its most true sense, right? It's guaranteed.
But if I finished off my 30-year term, so I did my time, I made it to the end. At the point where now zero time left, is there anything to convert at that point, or am I setting up a whole new possible
So,
term and a whole possible permanent? How does that work?
so with zero time left, what you can do potentially, which every insurance company is different, you could potentially renew your term life insurance if the option is available. Not every insurance company has that option. And what
Mhm.
that means is no medical underwriting. We don't need to worry about if God forbid you're sick, you've gotten diabetes or heart issues, whatever it may be over the time of having that insurance. You can renew it to another term life insurance policy, which will cover you for whatever the insurance company is willing to offer. Okay. Or you can go through the underwriting process again, which at the age of 60, 65 is not as easy as it definitely was when you were 30 or 35. But it's definitely an option. With that, you can apply for term insurance, you can apply for permanent insurance. My preference would be to convert to permanent insurance, but on, I don't know, let's say day 350, whatever it may be, payment 300. So I should say payment 350. So we're at a point where we know what the trajectory of everything's going. We know where we're looking and we're being proactive about it. And we're saying, okay, we've got our locked in low rates, like you said, for the 30 years. We've know that year, I don't know, 27 and a half. Well, all of these things have happened in life and our need for life insurance, term life insurance is slowly dissipated. So let's look at permanent insurance. We know we're all going to get there at some point. So we can convert that option with no medical underwriting. It's so much ease from the client end side of things, from the insured side of things, where for me, sure, there's paperwork, but that's my job. For you, there's nothing. All you have to do is review what permanent insurance you want, to have that discussion of what you need moving forward. And Bob's your uncle, we're done.